Okay, so last class we talked about the tax disadvantage of dividends. So the main reason is because of tax laws, right? Essentially, at least in Canada, you can see that the tax rate on dividend is higher compared with the tax rate on capital gains. So theoretically, the optimal dividend policy is a firm should never pay dividend, right? But then we get this dividend puzzle. That is, if you look at data, you can see that firm continues to pay dividends. So what is the explanation? And then we talk about this dividend capture and tax clientele theory. So basically, among the investors, some investors they have different preferences over dividend versus share repurchase because of their tax rate. For example, pension funds, or if you have a tax-free investment account. In this case, you will not care about the tax difference between capital gains and dividends. So this tax clientele theory basically says that a firm will try to optimize its dividend policy based on its tax clienteles. And then we started this part, which is called signaling with payout policy. So if you think about the first half of this chapter, it's about dividend versus share repurchase. And the main focus was actually based on tax policy, right? So it's really because of this tax rate differences in dividends versus share repurchase. Then we discussed several related topics. And now here we want to think about payout policies from the perspective of signaling. So when you're talking about signaling, then you would know that this is really based on information asymmetry. So again, firms, they know better than shareholders. So using dividend, firm can signal good information or bad information to its shareholders. And you will also see that using share repurchase, generally, firms can signal good information to its shareholders. And we started the first several pages on the signaling theory here. So our observation is first, we could observe that firms they generally pursue a dividend smoothing policy. That is, they would maintain very constant streams of dividends. So you can see that in the General Motors case, right? So you can see that the red curves, which tell you General Motors earnings. The red curves show you that earnings from GM are very volatile. And blue lines tell you dividends from General Motors. And you can see that dividends were really, really smooth, right, compared with the volatile earnings. And why do we get this result? Well, the reason is because management, they believe investors like smooth dividend. Now the question is, why do investors like smooth dividend? Well, this can be explained by dividend signaling hypothesis. So basically, the hypothesis says that dividend changes reveals manager's view about a firm's future prospects. For example, if a firm increases its dividend, then it signals a positive future prospect. Basically, the idea is if a firm can afford to increase its dividend, then it implies management knows in the future the firm will have good projects, will have good returns. That's why the firm can afford a higher dividend. Then to the opposite, you can see that if there is a decrease in the dividend, that is, if the firm decides to cut its dividend, you can see that this reveals very negative information because investors, they will think, why this firm is cutting its dividend? Well, it's because potentially in the future the firm will have bad prospect and the firm cannot afford its current level of dividend. So it has to cut it, right? So it's a very logic reason to think that dividend can reveal a firm's future prospects. And if you examine data will actually be quite consistent with this dividend signaling hypothesis. So you can see here during 1967 to 1993, firms who raised their dividend by 10 or more, right, their share price would increase by 1.34%. So basically, if there's a above 10% dividend increase, right, share price would increase by 1.34. And then on the other hand, if a firm decides to cut its dividend by 10%, and then share price will actually decline by 3.71%. And then this research also shows that if the change in the dividend is larger, then the share price change will also be larger. That is, if you increase your dividend more, you will see a larger increase in your share price. And if you decrease your dividend more, you will see a larger decrease in your share price. And then you should also see this asymmetric pattern. That is, if you increase your dividend by 10% on average, share price would increase by 1.34%. But if you decide to cut your dividend, then the market response is actually larger because the decrease in the share price is actually 3.71%, right? So you can see that cutting dividends reveals more negative information compared with increasing dividend and revealing some positive information. Now, this is basically a general result, but you can see that if you're the investor, if you want to think how firm's dividend policy signals its prospects, then it's really a case-by-case scenario. For example, if you're investing in a high-tech firm, right? And then this high-tech firm tells you that it wants to increase its dividend. Possibly investors will be unhappy. Possibly the share price of this high-tech firm will actually decrease. The reason is because it's a high-tech firm or it's a high-growth firm. So supposedly this firm needs money to invest a lot of high-tech projects, right? So basically this type of firm should have a lot of investment opportunities. But then this firm decides to return cash by using dividend. So you can see that in this case, it signals this firm couldn't find positive high growth investments. So this is actually negative information. Now let's say there's a very mature firm. And then one day this firm says that we decide to cut dividend. Well, the firm would also tell you that it decides to cut the dividend because it finds some new investment opportunities. And then you should expect that generally market will respond positively to this kind of news, right? Even it is about cutting dividend. So that's why I said in reality, it's a case-by-case scenario. Okay, now let's talk about share repurchase. Obviously, share repurchase is like the second form of returning cash to shareholders, right? There was a research in 2004 by these 4 professors. So they found out that 87% of CFOs, they agreed that firm would repurchase shares when firms' shares are underpriced. So this is interesting, right? This basically tells investor that if a firm decides to repurchase its shares, then this signals the firm's share price is underpriced, right? So basically, share repurchase reveals share underpricing. Clearly, you can see that if shareholders understands shares are underpriced, they would want to buy it, right? So share repurchase would serve as this this method to convey some positive information. That is, shares are underpriced. And if you look at data is consistent with this result. Well, basically, you can see that for different kinds of share repurchases, right? For open market repurchase, which is the main form of share repurchase, the average market reaction is plus 3% share price increase, right? And then for tender offers, it's 12%. Then for auction, it's 8%. So no matter what kind of share repurchase format you're looking at, you always see that the market responds positively to the announcement of share repurchase. Okay, now let's see this example here. So Clark Industries has 200 million shares, and its share price is $30 million. And it has no debt. So this is a all equity firm. And the firm believes these shares are underpriced. So they believe the true value should be $35 per share. And this firm plans to pay $600 million in cash by repurchasing shares at the market price. That is, at this $30 market price. And we suppose after the transaction is completed, new information comes out, and investor would understand that this firm is underpriced and the firm's actual value is $35. Now, let's see the questions. What is the firm's share price after the new information comes out? And how would the share price different if the firm waited until after the new information came out to repurchase the shares? So basically, the story is as follows. It basically says that the firm understands its shares are underpriced, but investors don't know this. So investors, they would still put $30 value on these shares. And now it's a good opportunity for this firm to repurchase its shares at a lower price, right? And then after this repurchase, shareholders, they will understand, well, the true value is actually $35. Right? So now we need to calculate what is the firm's share price after the new information comes out. Remember, the true value of the firm is $35. Does this imply the share price after the new information should be $35? Well, it is not. Right? So you have to be careful here. So let's see why it is not. So first, we can see that the firm has 200 million shares. So the initial number of shares, 200 million. And how many shares will be purchased by the firm? Well, it's $600 million divided by the current market price, $30. So this gives you 20. And then, what is the residual number of shares? this is easy, right? So basically 20 minus, sorry. So basically 200 minus 20, which is 180 million shares. Now to find out the firm's share price, and since we have got number of shares, what we need here is the total market value of the firm's equity after the repurchase. So what is this number? Well, first, what is firm's true value? Well, the firm's true value is 200 times its true share price, right? So it's 35. This gives you, I believe it's 7,000. Should we have million dollars here? Yes, it's $7,000 million. Now, what is the firm's market value after the transaction, after investors has learned the true value of this firm, right? So let's find out firm's value after investors understand the firm's true value. I can see that now investors, we have understood the firm's true value. So we should use the initial true value minus the $6 million, because this fraction of matter, this part of value has been retired from the market due to the share repurchase. So the residual value now is $6,400 million. So now we can find out the share price. It's the total value of these shares divided by the residual number of shares. So this gives us $35.56. So you can see here is this number is larger than $35, right? Let's see the second question. The second question says, how would the share price differ if Clark waited until after the new information came out to repurchase the shares? So in this case, when the firm went to the market to make the repurchase, then the information has come out. So you can see that investors will revise their information. They will essentially update and they will understand the firm's share price should be $35, right? So in this case, you can see that the share price would be $35. So the second case is pretty easy to understand, right? So how do you understand the first case? That is, why do you get a number which is larger than this true value? Well, the reason is because think about the repurchase, right? The firm made the repurchase when the share was underpriced. So you can imagine that shareholders who sold shares to the firm when the share price was underpriced actually suffered from a loss. And who got the gain? Well, the gain was enjoyed by shareholders who did not sell, right? So that's why these shareholders can get this higher share price than $35. And you could also see this answer here, which use this sort of this market value balance sheet to show you how this works. So you can see that before repurchase, right? We have 200 million shares, and we have a share price of 30. So the total market value of the firm's asset would be 6,000, and we know that the firm has $600 million cash. So the total value of the other assets would be 5,400. And then after the repurchase, right? After the repurchase, what we would see here is the firm's asset would drop to 5,400, and then we would have 180 million shares on the market. And next, the new information will be revealed. That is, investors will learn the true value of this firm. In this case, you can see that they will revise, right? These investors will revise their understanding on the firm's value. And the firm's asset will increase from 5,400 to 6,400. And we still have the same number of shares. So the share price would be 6,400 divided by 180. So again, the caveat here is you cannot just use this $35 as the answer to this first question. Okay. So we have finished this signaling theory here. Now, let's talk about a more general question. That is payout versus retention of cash. So let me show you this nice picture here. So basically, you can see that until now we try to focus on this part, right? So we try to focus on repurchase versus dividend, and we focused on this part from the tax perspective, and then we also discussed repurchase and dividend using this signaling theory. Now, what we wanted to do is we wanted to compare this retaining cash versus paying out cash. Okay. Oh boy. Where is the chapter here? Okay. Okay, good. So this is an important question, right? Because if the firm has cash, the first thing the firm wants to decide is not about dividend versus share repurchase. The first step is about how much money the firm needs to retain and how much money the firm needs to pay out. And after deciding how much to pay out, the firm would decide whether to use share repurchase or dividend, right? So this is the first important step here. Now we will assume basically two sets of results. First, if we're in a perfect capital market, if the firm has taken all positive NPV investments, then there is no difference about how much money the firm should pay out versus how much money the firm should retain. And then the second set of results, obviously, it is the results under more realistic conditions. So we will basically consider the trade-off between retaining cash versus paying out cash. So if the firm retains cash, then it will save some transaction costs because raising cash is expensive, right? And then, however, retaining too much cash can also generate cost. There is tax cost and there are actually agency costs. So let's see how this works, and let's first start from the simple case. That is the case under the perfect capital market. So obviously, if the firm has some positive NPV project, then the firm should not debate retaining cash versus paying out cash, because the firm should just think about how to best invest its cash, right? But if there are no positive NPV projects, which could be possible if you're a mature firm, right? So if there are no positive NPV projects, then the firm can either retain the cash to shareholders, or the firm can retain the cash. But now remember that we assume the firm has no positive NPV projects. So the firm can only use the retained cash to repurchase some financial assets. So essentially, we would assume that the firm will use the retained cash to buy some treasury bills, right, to invest. Okay, now you can see that the result should be clear to you, because we're having a perfect capital market, right? So if the firm tries to use its cash, its retained cash, to purchase some financial assets, then in this perfect capital market, by this argument of no arbitrage, we would know that buying and selling securities is a zero NPV transaction. So in the end, using retained cash to invest in financial assets will not increase or decrease the firm's value. So this basically tells you that if it's a perfect capital market, then retaining cash or paying out cash will generate the same result. Firm value will be the same, and investors' opinion will be the same. Okay, now let's look at this very simple question. So Yellowknife Mining has $100,000 in excess cash, and the firm is thinking about investing the cash in 1-year T-bills, which pays out 6% interest. Right, so this is essentially about retaining cash and invest in financial assets. Or the firm can use the cash to pay a dividend next year. Right? Oh, sorry, let me restart. So the firm can first invest the cash in a 1-year T-bill, paying 6% interest rate, and then use the cash to pay dividend. So that's the first choice. And second, the firm can pay the dividend now, and investor can invest the cash on their own. Right? And then the question is, in a perfect capital market, which choice would investors prefer? So if you look at the timeline here, right? So the first one basically says that firm will invest, and then dividend to shareholders. That's the first choice. The second choice is the firm just pay dividend to shareholders, and shareholders will invest. Right? So let's see what kind of payoff we can get under these two choices. So for choice one, you can see that the firm has $100,000 and it invests for 1 year. Right? Then it's 1 plus 6%. So that's the future value here, which is essentially, I think it's 1,00600. Now, you can see that the second choice. First, investor will get this $100,000, and then investor will invest. Well, it's still the same amount of money, right? So basically, you can see that for the first choice, the firm get this amount, and then this amount will be returned to shareholders in the form of dividend. So finally, shareholders will get this amount in their pockets. And then in the second choice, shareholders will first get this amount in their pockets. Then they will invest by themselves, right? So in the end, shareholders still get the same amount in their pockets. This is somewhat trivial, right? If you think about this in terms of in terms of present value, it's actually very easy to see. So basically, in the second case, the present value is $100,000. And in the first case, you can see that the present value is still $100,000, right? So if you have the same present value, obviously, shareholders will be indifferent between these two choices. Okay. Okay, now let's summarize. So this is called payout irrelevance. It basically says that if the capital market is perfect, if the firm invests its cash flows in financial assets, then the firm's choice of paying out versus retaining cash is irrelevant, and the firm's value would be the same, and its share price would be the same. Okay, now we could finally talk about a more realistic case. So let's first think about the role of corporate tax, right? How corporate tax will affect the firm's decision in retaining cash versus paying out. So to summarize here, corporate tax will make it costly for a firm to retain cash. The idea is pretty simple. So just think about this. Again, we assume the firm has no positive NPV project. So if the firm retains cash, the firm would have to invest in some financial assets. So let's say in this case, the firm decides to invest in some bonds or some treasury bills. And you can see that in this case, by investing in treasury bills, the firm will get interest payment from its investment. And the firm will need to pay corporate taxes on its interest income. Right? Now, think about this. Previously, we learned about interest tax shield, right? So if a firm is a borrower, if it has some debt, then it pays out interest payment. This interest payment is tax deductible, and it will serve as interest tax shield, and it will increase a firm's value. So this basically tells you that if the firm is doing the opposite, that is, if the firm tries to get or tries to invest in some bonds and get paid by interest payments, then it will have to pay corporate tax. So you can see that we're essentially talking about two opposite cases here. If a firm is borrowing money, it will have interest tax shield, and tax will provide some advantage here. The opposite side is if the firm is investing in financial assets, it will get interest payments, and it will have to pay corporate taxes. So you can see that cash is really like the negative leverage, right? Negative debt. So the tax advantage of leverage would imply that the tax disadvantage of cash. Again, the logic here is like this. With that, using some leverage, a firm will have some tax advantage. Using some cash, because cash is equivalent to negative leverage, so a firm will have a tax disadvantage from cash. Okay, now let's see this example here. So this will basically show you that through this calculation, the tax disadvantage of cash. So let's suppose Yellowknife must pay a corporate tax at 35%, and it will earn from the 1-year T-bill paying 6% interest rate. Now, would pension fund investors prefer that Yellowknife use its excess cash to pay the $100,000 dividend immediately, or retain the cash for 1 year? Of course, here we assume these fund investors, they don't pay taxes on their investment income. I mean, if you just look at this, you could see that clearly pension fund investors will prefer the firm to pay dividend immediately, because in this case, these fund investors can invest by themselves and their investment returns are tax-free, right? And if the firm retains the cash to make the investment by itself, the firm has to pay corporate taxes, right? The question here, of course, is about how to do the calculation here. So let's see. Okay, let's say the first choice. So pay out immediately. So in this case, if the firm pays out immediately, the $100,000 would be in the pocket of these pension fund investors, and they would invest by themselves. So in the end, pension fund investors would get 100 and 600, right? So it's 100,000 and 600. Second, the firm retains cash. So in this case, you can see that the firm will invest. However, in the end, the firm will have to pay tax. So what is the tax the firm needs to pay? Well, the firm has a 35% rate, and the firm's interest income would be, let me see, 100,000 times 6%, right? So, okay, let me see, what is this number here? So this is 103. You know what? I guess I could just calculate this by myself. What about this part? I think it's... Okay, let me use my calculator. 35 times 6. I believe it's 210. So this gives us 100,390. Let me see if sorry, I made a mistake here. Oh no, so it should be 10600. Okay, so it's $106,000. Then in this case, it should be 106,000 minus 2,100. Now this gives us 103. Yeah, this gives us 103,900. Okay. Now you can see this, right? So this part is the tax disadvantage of cash, right? And if you look at the calculation here, this is essentially corporate tax rate times interest return, right? Remember, how do you calculate interest tax shield? It's corporate tax rate times interest payment. So you can see that cash really represents negative leverage. Right? Okay. Okay. Oh, we have another question here. So let's say Microsoft. So we know that Microsoft paid a special dividend of $3 per share, or $32 billion during 2004. So let's say if Microsoft instead retained that cash permanently, right, then what would be the present value of the additional tax? So here, what we're trying to say is, if Microsoft retains this $32 billion and invest this $32 billion in some T-bills, then after getting interest income from its investment, it will have pay corporate tax. Right? Now our task is to value these additional corporate taxes. Okay, so what you can see here is the firm will have $32 billion retained. And then the firm will get, let's say we assume, so let's say we first assume a risk-free rate. Right, let's assume the risk-free rate is RF. So in this case, you can see that the firm will get a per year interest income of 32 RF. And you can see that you can see that Microsoft will get this interest income every year, like forever. So you can see that you can basically value the corporate tax using this perpetuity formula, right? So if Microsoft gets an income of 32 RF every year, then it pays corporate tax every year. And the amount is given by 32 RF times the corporate tax rate. Right? So now we will value these corporate taxes, which is easy. So the value is, let's just use perpetuity formula. Right? So discounted by the risk-free rate. So it's 32 times corporate tax rate. If we assume 35% corporate tax rate, we will have $11.2 billion. So you can see that the cost is actually pretty high. The firm has the excess cash of $32 billion. And if it decides to retain this cash, you can see that the cost from tax, the present value would be $11.2 billion. Right? It's about 1/3 of this total amount of cash. Okay. Now let's make some adjustment, right? Because we just discussed corporate taxes. Similar to our discussion in the valuing interest tax shield case, we know that investors tax will play some important role here. Right? So now, how do we measure the tax disadvantage of returning cash under both corporate taxes and investors' taxes? Obviously, when we are talking about investors' taxes, it could get complicated, right? When you're talking about investor taxes, you have to think about 3 different guys. The first guy is the tax rate on interest rate. The tax rate on interest income. And then the second is the tax rate on capital gains. Then the third is the tax rate on dividend, right? So you can imagine, if you want to think about the tax disadvantage of retaining cash when you're considering investors' individual taxes, then you will have to consider all these three different tax rates. The textbook has some derivation which tells you how to get a formula to calculate the effective tax disadvantage of cash. So here I will just use the I will just tell you the intuition here. If you're interested, you can read textbook to see how could you exactly derive this formula here. Okay, so first let's think about a case. A firm is retaining cash, and the firm invests this retained cash by itself, and after that the firm will pay out interest income as dividend, right? So what kind of taxes investors could face here? Well, there are actually three kinds of taxes. First, at the firm level, since the firm is using the retained cash to make some investment, then the firm will have to pay corporate taxes on the interest income it earns. And then the firm will pay out its interest income as dividend. In this case, investors will pay dividend tax. And then there is a subtle tax the investor has to pay. If the firm decides to retain cash, then the firm's value will be higher, and the total value of equity will be higher, which means there will be an increase in the firm's share price. It will actually generate some capital gain tax. Well, to see this, you can actually use a very simple balance sheet, right? So you can see that if the firm decides to retain cash, right? If you assume this is a all equity firm, you can see that cash will eventually add value of the firm's equity, right? So if the firm's equity's value is higher, then you should expect share price will be higher, right? So this will generate capital gains, and investors will have to pay capital gain taxes. Now let's think about the second case. That is, the firm decides to pay dividend without retaining cash. So in this case, you can see that the shareholder will pay tax on the dividend, and then the shareholders will make investments by themselves, and they will pay tax on the interest income. Now, what you can see here is, under the first scenario, there are three different kinds of taxes. And under the second scenario, there are only two kinds of taxes, right? So this gives you the rough idea that if a firm retains cash, then there is this disadvantage, right? Further, you can see that under these two cases, under both of these two cases, shareholders always need to pay dividend taxes. So if you're comparing the design of retaining cash versus the design of paying out cash, then the dividend tax will not matter, because under these two cases, right, under the comparison, if both cases have dividend tax, then the effective dividend tax will just offset with each other. So in the end, the effective disadvantage of retaining cash will be determined by corporate tax rate, and capital gain tax rate and the personal interest tax income. Sorry, and the personal rate on interest income. So let's see the formula here. The effective tax disadvantage of cash is defined by this formula. So this is corporate tax rate, this is capital gain tax rate, this is tax rate on invest income. What you can see here is if corporate tax rate increases, or if capital gain tax rate increases, then the cost of retaining cash will increase. And you can also see that if personal tax on interest income increases, then the cost of retaining cash will actually decrease. So this is intuitive so this is easy to understand. Just think about this, right? So why there is this tax disadvantage of retaining cash? Well, fundamentally, it's because interest income received by the firms will be taxed at corporate tax rate. So you can see that if corporate tax rate is higher, then the cost of retaining cash will be higher. The tax disadvantage of retaining cash will be higher. And then you can also see that if the firm decides to retain cash, it will boost up its share price, then this will generate capital gains. And if capital gain rate is higher, then the cost of retaining cash is higher, right? So in this case, you can see that the tax disadvantage will again be higher. Now, what about the personal tax rate on interest income? So in this case, you can see that if the tax rate on interest income is higher, this essentially means that the tax advantage of paying out a dividend becomes smaller because investors are suffering from a higher tax rate on interest income. This is equivalent to say the disadvantage of retaining cash is smaller. If we use actual data, so for example, if we use 2017 tax rate, I'm using numbers from the 4th Canadian version. And what you can see here is if you plug in numbers, right? So average corporate tax rate, average income tax rate, average tax rate on interest income, and average capital gain tax rate. What you can see here is the effective tax disadvantage of retaining cash in Canada is actually negative. So what does this tell you? It tells you that in Canada, retaining cash can actually generate tax advantage. Now, the case would be different in the US, right? So if you use the 4th US version, use the data from 2015, then what you can see here is in the US, there is a large tax disadvantage of retaining cash. It's 13.9. It's almost 14%, right? So why do we get this different result? Well, it's really because of tax rate. If you see this, right? If you see this number, so you can see that the tax rate on interest income is about 10% higher in Canada. And what does this mean? Well, this means the tax disadvantage of cash will be smaller, right? So you can see that because Canada's tax rate on interest income is 10% higher than the US, then this implies that the effective tax disadvantage of cash in Canada is smaller compared with compared with US. And you could also see this from the corporate tax rate. So Canada's corporate tax rate is about 8% lower compared with the US. So in this case, you can see that if you have lower corporate tax rate, then the tax disadvantage of cash will be also smaller. So again, this will push Canada's tax disadvantage of retaining cash to the smaller side. So in the end, we will get a negative number. Of course, you can see that these numbers actually changes. You can see that now the US has a tax rate, I believe it's 25% because Donald Trump changed the tax rate, I think it's in 2017, right? So if you use a different number, I guess now the number would be actually smaller. Okay. Now let's explain this result. Why after our calculation, we can show that at least in the US, right, retaining cash has tax disadvantage. Then why firms still have large cash balances, right? Well, there are several reasons. The first is cover potential future cash shortfalls. The reason is because if a firm has investment opportunities, or to be more specific, if a firm has some unexpected investment opportunities, and let's assume in this case the firm has no cash. Now what the firm can do? Well, the firm has to get external cash through either issuing some corporate bond or issuing some equity. However, in the market, raising new capital using debt or equity is actually pretty expensive, right? So I can see here the cost of debt is about 1% to 3%, and the cost of equity is about 3.5% to 7%. So you can see that, well, even this is a small percentage, but in reality, because generally the value of issuance is quite large, so the absolute amount is also quite large. For example, if you look at the recent financial news, the Ant Financial from China, they tried to file a IPO, so their valuation was $35 billion, and the fee for the IPO was about $400 million. So it's just a little bit more than 1%, but still $400 million is a very large sum, right? So you can see that it's very costly to issue equity. And then the second reason is some firms they have quite volatile earnings. In this case, you can see that if a firm's earnings are volatile, then clearly this type of firm needs some higher cash reserves. Because just imagine this, due to its volatile nature, in a particular year, the firm's earnings could be very low. In this case, the firm will have some difficulty to use its earnings to cover its financial liabilities, right? So the firm really needs some cash cushion to avoid this financial distress cost, right? Okay. Clearly, you can imagine that if a firm has too much excess cash, then it could be bad. So if a firm holds cash above its investment needs and liquidity needs, then it could incur some cost such as wasteful investment, right? We learned about this. We learned about this in the last chapter. That is, under this free cash flow hypothesis, we assume that if there's too much cash flow, then managers will want to use these redundant excess cash flows to make some inefficient investment. This will ultimately reduce firm's value. Right? So you can see that if a firm has too much cash flow beyond its needs for investment and liquidity, then it's better for the firm to pay out these excess cash reserves to its investors. Of course, in this case, the firm can either use dividends or share repurchase. So essentially, you can see that now we have something similar to the trade-off theory, right? So when a firm is thinking about retaining cash versus paying out cash, it has to think about, first, obviously, taxes. But then second, it has to think about the following costs versus benefit. Right? So retaining cash, it has the benefit of offering some financial, it has the benefit of first, avoiding financial distress cost. Second, it could offer financial slack for future growth opportunities. That is, if the firm has some investment, then it could use its cash reserve to pay for this investment. And then you have to compare these two benefits versus costs. There is this tax disadvantage of holding cash, and there is this potential agency cost of wasteful investment. So you can see that from this trade-off theory, you can see that why high-tech firms, they have little debt and they have a lot of cash, right? The reason is because you can see that if you're a high-tech firm, you will have a lot of future growth opportunities, right? So you would really want to get some cash in case you have some opportunity in some project. And then you would also want to avoid financial distress cost because high-tech firms generally don't have a lot of fixed assets. So, and you could also see that high-tech firms generally have volatile cash flows. So they, under these two features, that is volatile cash flows and low physical assets, will actually put this firm into danger if it has large amount of debt or it has little cash. Right? So the high-tech firm would have the incentive to retain large amount of cash. So this is a table which tells you the the amount of cash and short-term investments in these high-tech, not necessarily high-tech firms, in these firms, in these large firms. So here you can see that we're talking about cash. So this ST here refers to short-term investments, which are very liquid investments, and these investments can be quickly turned back into cash with a very short notice. So you can see that these firms have large amount of cash. And if you look at the percentage of market cap, you can see that Microsoft, right, 24%, Cisco 47%, and then this guy General Motors has like 84%. Okay. Now let's see this problem here. So Sand Oil is an all-equity firm with 100 million shares outstanding. This firm has 150 million in cash, and its future free cash flow is actually $65 million per year. So let's say the management plans to use the cash to make some new investment, and then future cash flow will increase by 12%. And the cost of capital is 10%. So how would a decision to use the cash for share repurchase rather than the expansion would change the share price? So basically we have to calculate the share price under share repurchase and the share price under expansion. So it's basically a valuation exercise. Right? So let's first calculate share price under share repurchase. So basically in this case, if the firm makes share repurchase, if we assume this is a perfect capital market, so we assume no taxes, then firm's share price should not change, right? So we just need to calculate the firm's initial share price, right? If you look at these numbers, so let's see how can we find out the firm's initial share price. Oh, we have 100 million shares. So now we need to find out the firm's value of equity, right? Well, we can basically use the valuation formula. So the firm would have a $65 million of cash flow in perpetuity, and it has a 10% cost of capital. And then it also has this $150 million of cash reserve. Right? So this gives us a value of $800 million. And now the share price would be 800 divided by 100, which is 8. Right? Now let's think about share price under expansion. So again, we have the same number of shares, right? So we have 100 million shares. And now let's find out the firm's value. Well, the firm will use this $150 million to make investment, right? And the firm's cash flow will increase by 12%. So its per year cash flow would be 65 times 1 plus 12% divided by 10%. So let me see what is the, so it's 65 times 1.12. So this gives us 7.28. Clearly what you can see here is expansion actually reduces the firm's share price from 8 to 7.28. So why? Why do we get this result? Well, let's look at this project itself. Right, so in this case, you can see that the cost of this project is, well, $150 million, right? So what is the present value of this project? You can see that without this project, firm's cash flow would be $65 million. With this project, cash flow will increase by 12%. So this tells us the cash flow from this project itself is 65 times 12%. And now we will discount this project at 10% cost. So this gives us, I don't know what is this amount. I guess it's 7 let me see, what is this? It's 78. So it's $78 million. Now, what is the NPV of this project? Well, it's minus 150 plus 78, which is minus $72 million. So you can see that the per share loss, or the cost per share, is this total loss divided by the total number of shares. So it's 0.072, right? So it's exactly the share price difference under these two scenarios, right? So you can see that the story here is basically the management of this firm is making wasteful investment, right? And this wasteful investment just reduces the firm's share price from $8 to $7.28, right? Okay, so this problem is actually I would say it's a interesting one. So take some time to solve this and try to understand this. Okay, today's class will be, so I will stop here.